Good evening, everybody. I am Mark Sebastian, founder of OptionPit.com, and this is Volatility and Earnings, the Option Pit method. So we're going to discuss using volatility to analyze earnings. This is me. If you don't know who I am the good-looking redhead on the right. I know my voice sounds a little deeper than normally on Fox Business News, but you know, that's the magic of Hollywood. That creates that. Yeah, it's the magic of Hollywood. So no, I'm kidding. Obviously, you can tell which one I am. And yeah, I was a trader on the floor for about a decade. I then left and started Option Pit. We are an education and consulting company. We work with high net worth individuals, regular individuals, and as well as we do a lot of work for hedge funds and trading firms, helping them implement and test option strategies. In addition, we do run a private hedge fund called Carmen Line Capital, which is for accredited investors only. But we are traders who teach. We are not educators. So I'd like to remind everybody that today is for educational purposes only. None of this should be considered investment advice. Options have risk. Consult your financial professional if you have questions. So volatility can act like a headwind or a tailwind to successful trading. All right. So what we're going to discuss some basic buy-sell decisions to profit from trading. We're going to do analysis of expected stock movement. We're going to be building a trade around earnings, and we're going to discuss earning flies. And then at the end, if you stick around, I will look at some trades upon your request, so we can spend some time looking at a couple of trade ideas if you want. So has this happened to you? I get this story every earnings season at least once. Mark, market makers are cheaters. I bought all these calls right before earnings. The stock is way higher, but I'm not making any money. Market makers stole my money. I don't know how they did it, but they did. And, you know, that's obviously not true. What happened was movement expectation changed. All right, the insurance value of your trade changed, and thus your ability to make money changed. That is what happened. So we will discuss why and how now. So there are three main types of volatility that I look at. Realized, historical, and implied. Each one has its own use in trading, really. So what is realized volatility? This is the one that I think confuses people the most, believe it or not. Because it really is historical, but it's not. So what drives realized volatility is movement. All right. So think of it as, how is a stock moving right now? All right. While all moves end up being historical in nature, what you're really looking at is, what is this thing doing now? All right. What is Apple doing right now? Is Apple in the middle of a big momentum run? Is the Russell in the middle of a big momentum run? What is going on? What is driving pricing? All right. One decent measure we look at is something like 10-day HV, 10-day realized volatility, 10-day historical volatility. So here's Goog. You can see what it was leading into this. I can pull it up today. Here's a chart of Google. There's 10-day realized vol. So 10-day realized volatility is 11. So it's been moving about 11% on an annualized basis per day. All right. So now, what is historical volatility? So historical volatility is just realized volatility with a longer view. All right. It's how much an underlying has typically moved in the past. I typically look at it in month increments or in 2-month increments. And but I do look at, you know, year-long ranges to see really what is my baseline. And historical volatility, unlike realized, which can really go anywhere, historical is mean reverting. So this is Goldman Sachs, realized volatility. And we're looking at 10-day, or Goldman historical volatility. 10-day is that that realized volatility. That white line is the realized volatility number I'm looking at. And the white line, which can go as high as 50, touches down below 10. Meanwhile, the 20-day, which is the first real line that I can use that as kind of a baseline to look at, ranges from about 38 to about 20. Meanwhile, 60-day HV ranges from about 24 to about 28. And if I go a lot further out, so here, I'll pull up another Google chart here. So you can see it definitely moves around. Let me pull it out. You can see 10-day moves around. Now I'm going to add 360-day vol and 180. So take a look at this. Now, if you look at this just from the naked eye, you go, wow, the range is basically 20 to as high as 27. That's going to be my baselines. So on this big long thing, when realized vol is kind of below this 20 number and above this 27 number, I'm going to consider that kind of hot. All right. I can also use like 6-month vol. That's going to give you a little more range. So as you can see, it's at its lows right now. So I would say 16 vol to 32 vol would be my ranges. So what I'm looking at is, okay, what am I looking at for what is a lot of movement and what's a little movement? And so I might take these two charts and say, well, when we're above 27, movement's starting to get a little hot. And when we're above 33, movement is hot. And when we're below 20, movement's starting to get a little soft. And when we're below kind of 17 or 16, movement is absolutely soft. Does everyone kind of understand the difference there? You know, there's a difference between kind of starting to see that things are getting expensive versus actually expensive. You know, you might think of, you know, the long-term vol, the year-long vol as maybe your canary in the coal mine, and your 180 as alarms are going off. All right, now let's talk about implied volatility. Implied volatility measures how much the market is expecting the underlying to move. It's forward-looking, attempts to be, and it's based on the price of the options. So it's basically an output, not an input. This is the problem, all right? And there are many index based on this, or one can use a broker platform, all right? So when I look at implied volatility, what really implied volatility is, all right? All right. There are 5 main factors that go into calculating volatility. Or calculating an options price, excuse me. There are 5 things that go into calculating an options price. Do we know what they are? No, those are the Greeks. Someone said delta, theta, rho, vega. Those are the Greeks. Those don't control the options price. The Greeks are actually an output of the pricing model. All right, I will tell you. Price time, that's correct. Yeah. So you've got underlying price. You've got timed expiration. Someone said interest and dividends. That's called carrying cost. That's cost of carry. And then strike price. And then someone said volatility. What volatility does the model use? And the model does not use historical volatility. Implied, that is also incorrect. Remember, I said implied is actually an output of the pricing model. So the model wants to use forward volatility. All right. So forward volatility is basically an option is worth how much it's going to move in the future plus these other four factors. Now, does anybody know how much stocks are going to move in the future? Does anybody here know? No, everyone guesses. Right. So your problem is we don't know this one. So that Black-Scholes guy doesn't know it either. All right, so what we end up doing is we end up actually doing it this way. So we take those five factors, and that's stock price plus strike price plus cost of carry. Now it's a big complicated formula, plus timed expiration, plus forward volatility we don't know, equals the options price. All right? So we know the options price, and we don't know forward volatility. Right? So implied volatility is really we move the option price to this side, and we move forward volatility to this side. So implied volatility, where you're getting your Greeks, you know, this pricing model that gives you your risk Greeks, it gives you kind of everything. Does it seem like there's a problem here? So it gets all of its risk analytics from the options price, but the options price is determined by implied volatility, which is derived from the options price. Does anybody see the circular logic there? Yeah, it's a chicken and egg scenario. So basically, right, so basically the thing that really solves and really comes up with volatility is supply and demand. Yes, the pricing model is based on supply and demand. So as the options price move, implied volatility moves. All right? And that is what is driving it. So as the option price moves, because of supply and demand, that is going to then change volatility, which is then going to change all of your Greeks. Did anybody, I feel like I had a couple aha moments here. Isn't this awesome? So that's really, so vol is defined by demand. Yes. Implied volatility is a function of supply and demand. And so are your Greeks, and so is your risk. And so that is why an understanding of implied volatility is so important. Because if you understand implied volatility and when supply and demand is out of whack, you can absolutely hit it out of the ballpark. Because the nice thing to know is everybody believes in mean reversion and implied volatility. But supply and demand can throw things so out of whack. So now I want you to take a look at this chart of VXGS. All right. Now, this gray line that's super flat, that is the 200-day moving average. Now, does that look like an index? So VXGS is the VIX, Implied Volatility Index of Goldman Sachs. Based on looking at that line, do you believe that there is some mean reversion within Goldman Sachs Implied Volatility? Yes. Yes, there is. So when it gets dirt cheap, you know, so anybody that says you shouldn't buy options, do you think they might be wrong sometimes? There are tons of times to buy options. There are also times to not buy options. All right. The way I always think about it is 50% of the time, options are overpriced to some degree. 20% of the time, options are fairly priced. And 30% of the time, options are underpriced. And interestingly, when they're underpriced, they tend to be way more underpriced than they are overpriced when they're overpriced. So, over the long term, we know where implied volatility of a stock or index is going to go. We do not know where the stock price is going to go. Implied volatility mean reverts. So there's that Goldman Sachs. You see a mean there? No. And there's a mean there for sure. So again, that stock price can go anywhere and stay there, while volatility can go anywhere. It can't stay there. It must revert to its mean over time. Understanding this can help with buy and sell decisions. All right. Any questions on implied volatility? How do I imply, how do you define under and over? So when you look at, so really when you're defining under and over, it's kind of going back and looking at how things were priced. Does that make sense? So you don't really know until you go back and look. But typically that's about the way things shake out. What does SV stand for? I'm not sure, Ray. You mean comparing HV and IV? That's correct. So you look at what IV was today, and then you go back, and then you go forward 20 days and look at what 20-day historical volatility was, and then you get a good idea of whether implied volatility was right or wrong. Statistical volatility. I've heard that term. I've never used it or played with it, and that might just be kind of where are things within their range. That's what it sounds like. Personally, I've never used it. So now let's look at IBM. All right. Oh, let me talk about hard versus soft deltas first. All right. So now, when trading earnings, the concept of hard versus soft delta is so important. All right. A hard delta is a delta that is going to act the way I expect it, whether or not volatility changes or not, generally. So if volatility drops, will my option still make money? Or if volatility increases, will my option still make money? How is my option affected by volatility? Hard deltas are deltas that are relatively unaffected by changes in implied volatility. All right. Then we have soft deltas. Soft deltas, on the other hand, are a little different. They are generally out of the money options, and their price can vary wildly based on how volatility moves. And understanding the difference can make a huge difference with strike selection. So take a look here. This is IBM prior to earnings last week. And you can see you've got puts here. And you've got out of the money. These here, so take a look here at these deltas. You know, these 4, 5, and 9 and 10 deltas, those are going to be soft deltas. You know, if IBM drops and IBM's 166, so if it had dropped the day after earnings down to 162, I still would have lost money on these guys. If it dropped to 162 on these guys, I would have made money. These are my hard deltas, my in the monies. So think about it that way. If you get a wild volatility move, but you're right on your direction, all right? So I picked the right direction in volatility. I buy a call. Volatility drops wildly, but the underlying moves up a lot, or it moves up some. If I'm still making money, that was a relatively hard delta. If I buy an option and the underlying moves up and volatility comes in wildly, and I don't make money, I probably was carrying a soft delta. Hard delta is in the money or more at the money-ish, and soft delta is going to be out of the money. So now, does everyone understand the difference between a hard and soft delta before I get into analyzing earnings? All right, no questions. All right. Good. All right, so now, the key to understanding earnings is to understand the straddle price. The straddle is the market's best guess at how much the underlying might move between now and expiration. It is about 80% of a standard deviation. All right. A straddle price in a straddle is really the at the money call, the value of the at the money call plus the value of an at the money put. All right. The at the money straddle price of the weekly option of earnings week is going to give you the market's best guess at how much the underlying might run on earnings. It is rarely dead on, but over time, its average price is somewhat accurate. So here's IBM, and IBM is trading, again, 166.76. The weekly straddle does a decent job of guessing the move most of the time. More often than not, the underlying moves less than the straddle is predicting. However, when the straddle is wrong, it tends to be really wrong. So you understand the difference? So most of the time, the straddle is too expensive. But when it's not, it tends to be way more wrong. So we can actually go back and look at IBM now, which is nice. We'll do that in a second. All right. So that IBM strangle, the 165, 67.5 strangle, priced itself about $4.52 with the stock trading 166.75. So, you know, close enough. I basically add, you basically call it right in the middle, and you slap $1 on there, and your straddle is $5.52. Call it a 4% move. So knowing this can be really valuable. The next step is to look at historical moves. All right? And I'm going to say this rule a couple times. If you want to make money buying options on earnings, never buy options outside of the net straddle price. So if my straddle price is 552 and my underlying price is 166.76, I never want to buy a call greater than like 172, and I never want to buy a put below 161. All right. So now let's just briefly go back and look and see what IBM did. Now this is just from last week. Well, as you can see, at this point, it would have been a winner. But let's look at what it actually did on the day after earnings. So my straddle, remember I was buying that 166, so it started here, and it settled 170.55. So at the time it was 166.75, so it moved $3.25. So it underperformed. Now here's the part that kills you, and we're going to talk about, I'm not going to talk about this, but this is something I look at a lot. So I'm going to look at the Thursday night. This is right before earnings. And there's my strangle, 215 and 260. So 465. So basically anywhere out, basically call it $5. So above 172.5, below 160 was kind of what I was aiming for. Well, those did not win. But what about the following week? How much more expensive was that if I wanted to play long? Well, I could have bought that strangle. Instead of for $465, I would have paid $290 and $245. I would have paid $535. So I paid an extra 80 cents, and I would have gotten a whole week to look at it. Well, now, today, how is my strangle looking? How did my strangle go out today? Well, my put is worth 2 cents, and my call is worth $11.15. You would have basically doubled your money. So one thing to think about is you don't have to look at earnings week. And that's not a slide that I've got, but it's just something to think about. So now, setting up a directional play. And here's how we could have maybe set something up that would have won. So directionally playing earnings, I want to use soft deltas to my advantage. All right, so take IBM in earnings week. The use of spreads is key when playing directionally, earnings directionally. Takes advantage of volatility in the soft deltas and keeps that hard delta. There's IBM. So what if I thought IBM was going to go down? All right, what if I bought the 167.5, 160 put spread? Now, obviously, that didn't win, but take a look. I've got the 167.5 put, and I've got the 160 put, paying about $2.50. So my spread, my 167.5, 160 spread costs $3.16 minus 62, or $2.54. All right. The soft delta, you'll recall, being that out of the money put. The hard delta being that at the money or in the money put. All right. So it costs me $2.50 to make $5 if that spread goes full on. So I'm really getting about a 2-to-1 ratio. All right, now, what about if I just bought the 167 put? Well, if it goes to 160, and this is where that scenario analysis is important. If it goes to 160, I'm paying $3.16 to make $3.34. That's about 1-to-1. I need an extra $2 to $3 of movement in order to make as much as I do in terms of yield on yield. My return on risk. So in this case, I'm selling that soft delta and buying the hard delta. It's a nice little spread. All right, now a cheaper alternative to that trade is to set it up the long as a soft delta, but inside of the straddle price, and then sell the really soft stuff outside of the straddle price. Something with some meat to it. So here's a bull spread I could set up in IBM. I could buy the IBM 170 call and sell the 175 call and pay 110. So, you know, if I buy the 170 call for 140 and sell the 175 at 30 cents, I'm only paying about $1.10. That's inside of my strangle price. So now, as we know, my IBM didn't win at the close. However, I'll tell you, buying the call and selling that out of the money was pretty nice. And if we look at the range on the day, my guess is the range on the day was a lot wider. All right, so those are things to think about. And actually, overnight, IBM had been over 172. So if I had portfolio margin and I was able to trade stock against my options, I'd have been in tip-top shape. Now let's talk about earnings wings. Wings are kind of the out-of-the-money stuff, soft deltas. Now, about the only thing that truly gets bid up into earnings are those out-of-the-money wings. And they should be sold to the dumbest person that's willing to buy them. All right? And so what I suggest is actually putting together a butterfly. So you can see this is kind of the way skew looks, and here's it on a 3D look. You can see where expiry and moneyness and skew changes. And you can see how near dated options have a really steep skew, long dated options do not. Here's another look at skew. The out-of-the-money butterfly is the best way to trade for direction as a simple trade. All right, I could have set up just about 50 out-of-the-money trades that would have won in in my spread here. When I buy the IBM spread, do I close it before or after earnings? Generally speaking, Trevor, I almost never take anything in earnings. But if it's not winning and I like my odds, I will carry it through. All right, I'll show you a better skew graph here in a little bit. All right. So the key is to set it up right. So what I do is I set my long at or near the end of the expected move, and then I sell junk outside of it. So here's Google last week. This was a trade that I looked at as a potential trade last week. The straddle. I was pricing out the straddle price. So the nice thing about earnings upside is junk gets way overbought, way out of the money stuff. So, and I like doing this stuff, you know, ahead of time. I find that you get a lot more edge trading this stuff ahead of time. So what I would suggest is in Google, buy a call or a put at the edge of the earnings straddle, sell junk upside, and buy a cheapie for margin. With Butterfly, you do have to be right in direction, but you can get it on really cheap. So last week, this was the trade I built. So I could have bought the Google 850 calls for $8, sold 2 of the 870 calls at $355, and bought the Google 890 call for $140. Net total, I was paying $235. It's not better than a payout of almost 10 to 1. All right. And what I was taking advantage of was this skew. So now I'll show you that good skew chart. Well, I can make as much as $20, and I'm paying $2.35. I'm not actually going to make that much, but I could. So here is a crazy skew chart. So here's Google at 8. I mean, this is just a nutty skew chart. This is super flat. Now here's a chart of just Google split. So this is what skew looks like. You can see all the different, each point is a volatility. You can see Google was down about $18 after earnings. Probably going to be up on the day tomorrow, would be my bet. But what I want to show you is this was a trade I set up last week for a similar webinar. Well, take a look at how it looked today. See, I had the 850, 870, 890. Well, there's that spread. This is the spread last week. And here it is today. Oh, geez. I'll just pull it up here. Thought I took the right picture. I did not. So here's Google. And my spread, my 1850s are worth, let me reset this. So here's my spread, 1850, 1870, 1890. So last week was $2.35. This week it's $3.50. Now I would have closed this before earnings. Why? Because I made $1.15 against $2.35. That's 50%. And then I don't have to deal with earnings. Earnings are a crapshoot. You want to eat that uncooked? Have a piece of that bread. I bought hummus. Oh. In case you guys wanted to know what's available to eat at my house. What's that tick chart? What's that tick chart different from candle bars? I'm not sure what you're talking about. Oh, these are candles. These are like 1-minute candles. So the point is, there's an opportunity to make money. All right, so now let's talk about vol premium sales. Now, if you're a total options expert and you know what you're doing, this does not apply to you. All right, but for your average novice trader, you're going to see all sorts of people tell you that there's easy money in earnings. There is not. All right. My friend Russell Rhodes, he and I do a podcast every Friday together. I'll be on with him tomorrow, called Volatility Views. Russell has done extensive research on buying straddles. That platform I'm showing is called LiveVol, and it's LiveVol for light speed trading. And it is the best option platform out there by a curbillion. If you have interest on it, shoot me an email and I can hook you up with the people that run it. It's actually cheaper to trade on too. So my friend Russell Rhodes did a big study. He studied thousands and thousands of earnings. And you know what he found out is that people that buy straddles tend to, over time, they lose. So what do you think that means? You think people that sell straddles over time win? What do you guys think? All right. So, no, people that sell straddles over time into earnings lose. I almost never do double diets. No, people that buy straddles lose. People that sell straddles lose. If done over time. All right, so think about that. Everybody loses. So what do you think that's derived from? Why do you think everybody loses? And this is earnings, not regular straddles. All right, if you sell straddles most of the time and you don't include earnings, so straddles in like the S&P 500 theoretically do win over time a little bit. Not a lot, but a little bit. Not as much as is being shown. No, you want to know why? You want to know why you guys win? Why both sides win or lose? So let's price out a Google straddle. All right, closed. We'll use the 855 straddle. All right, so the bid is 33.20. The offer is 34.50. Even if you tighten this up a lot, you're going to end up at least giving the market makers 10 or 15 cents on either end. And that 10 or 15 cents is about how much you lose by it over time. So the bid-ask spread is what causes straddles to lose over time. So anybody that says, oh yeah, set up earnings trades where you sell premium, those will lose eventually. Those are not a long-term winner unless you absolutely know what you're doing. All right. Now, there are ways to develop earnings trades that can win. There are. I showed you a few ideas. Obviously, a 45-minute webinar is not going to answer all the world's problems, but I think I kind of opened your eyes to kind of what's out there. So now, in summary, vol reverts and sell the junk. Buy inside the tent. All right, so now I want to tell you about what's going on. All right, and stick for this, and if you stick through the offer, I will answer questions. I'll look at earnings. I'll look at earnings for a couple stocks for you guys. All right. So next Saturday the 4th, we are doing trading long options and managing gamma. All right. When we sell it recorded in our store, we are going to charge $300 for it. Today, it is just $197. You use the special code 25_off, and you take an extra 25 bucks off. So it's only $172. Right? And it's going to be about 4 hours. We're going to talk about how to buy options, how to manage gamma, how to scalp gamma, how to use volatility, how to ride vol cycles, how to manage risk. And really, I think the big key is we're going to teach you how to implement long gamma into a option premium seller's portfolio. All right. The way I always tell people is we want you to own enough options where if the market drops 20%, you are making money. And actually, generally speaking, the way we're going to teach you, you should be able to make money being long options at the same time that you're making money being short options. Not in the same stock, not in the same index. This is a webinar for, long-term traders, swing traders, traders that trade every so often, it's not for day traders. This is for position traders. You go to optionpit.com/gamma. And actually, incidentally, that is where the replay of this webinar will be. All right. All right. So who's got stocks they want to remember? Optionpit.com/gamma. Who's got stocks they want to look at? I will look at 2 stocks. So everybody throw out a stock they want to play. They want me to play with. All right, I'm going to pick ones that I see twice. I feel like I should do Apple because everybody loves Apple. Yeah, so the nice thing is if you take the course and you miss it, we will send you a replay. So you get to keep the replay. All right. So I've seen Priceline twice in Facebook. So tell you what, we'll do Apple, we'll do Facebook, and we'll do Priceline. How's that? All right, so now let's talk about Apple. All right, so now what I want to start with, I'm going to just show you how I analyze an earnings set. So Apple implied 30-day implied volatility is about 19. And I want you to look at this over a 2-year chart. And the crazy thing is, in 2015, you would have considered 19 to be screaming, buy every option you can. Now, it's also been kind of the low end most of the time for the year, except for kind of right now, where we're about 20. All right, so going into tomorrow, or not tomorrow, going into next week, let's see how they're pricing this thing. All right, so the stock's 122. They're pricing a $4.50 move. $3.5%. All right, so let's see what this thing has done in the past. We'll just look at the recent past. All right, so we've seen a $10 range. We've seen last July it had a $10 range. The previous April it had a, call it a, It moves $6 on earnings. Let's see what it did. Now here's one where we go from 100 down to, here's a $7 loser. It moved about $5 here. So as I'm looking at this, this is by far this is about as cheap as I've seen these gone. Groupon. No, thank you. We call that poupon. So $4.50 is about as cheap as this gets. So I'm going to start by saying I would not sell this straddle. I might not buy it, but I don't think that premiums in Apple are worth selling. So now looking at, you can see we've got decent curvature. All right, so I think that if I was going to set up a trade, I mean, 450. What do we get out of the one? $6 away. So you get a ton of juice on a relative set, relatively speaking, out of the 1/16s. $3.60 for a $6 for $3.64 for a $6 butterfly is super cheap. Super cheap. Now the question is there a smarter way to set that up? So let's go to the following week. Let's do this for another. So I may only hit up 2. I didn't realize it was 8:30 already. The following week, the straddle is still less than $5. So I would, if you were looking for a trade that I would set up, I would buy the straddle and sell the strangle. I'd sell the strangle $5 wide outside of the straddle. So at 127 and 117, and I'd buy the strangle and I'd pay $3.87 for that. So I'm legitimately paying 16 cents more for this, and it puts me in a great position to be long momentum into earnings. The Gamma course is February 4th. So a week from Saturday. All right, so there's my Apple idea. Now, let's look at, what did I say, Facebook and Priceline? Let's do Facebook. All right, Facebook is one I like as a long-term play. And of course, I'm waiting for the options to populate. Well, the rationale is I may get a chance to own next week's straddle really cheap. So if I sell that strangle, and it moves a little bit, the strangle may collapse. Yeah, I'm long the Facebook So I do have a position in this, in that I'm long the 150 calls. I'm not sure why I'm not getting, there it is. Now it started populating. I sold a couple out today. I think I'm long 35 now. I like those as just a long-term play, the 150s. And I bought them all the way down to Facebook going to 110. I was just buying, buy more, buy more, buy more. Now, Facebook, if I look at a chart, they've got earnings on the first. Now, that vol is not nearly as cheap. You see that? See the difference between Apple and Facebook? This is a little bit more of a crapshoot. So with Facebook, they're pricing in a, call it a $7.25 move, 7.25. That's about what is that? Almost 5%. My handy dandy calculator. 7.25 divided by 132. It's over 5%. So they're pricing at about a 5% move. And then if I do my little earnings analysis, so that's right, you go to optionpit.com/gamma. And let's see, last time it was, call it has $17 range, but really 130 down to, it was kind of $10. Previous time was $3. Time after that was 12. All right, so Facebook is one that I think is going up. I think they're going to report good earnings. And granted, I love the stock. Facebook is, there's a lot of the interesting is people love Tesla for some reason, and yet people use Facebook all the time and don't contemplate that maybe that's a name that could go up to infinity. Trust me, I'm based on the amount of dummies I'm filtering out of my feed, Facebook stock is going to be going way up. So my straddle is $7. So I like to make my long for a fly something less than $2. So maybe I'd look at the 137s. Those still have some meat to them. All right. Now, even when it blew the doors off earnings, it only went up 10. So I would look at selling the 142s at 68. That's a $5 move. And then they're going to make me buy the 146s because they don't have 147s. That's fine. It's a broken wing fly. I'm paying 80 cents for this fly. And it's actually, I like the way that's structured. I may actually do this trade. And let me show you how it's set up, why I like it. Let me center this around 137, where I think this is going. So the nice thing is, if I buy 10 of these, I can lose $800, and that's if it drops. Really, any real move higher and I make money, even with vol shocks. I'm going to vol shock it down to 60%. So I'm dropping volatility 60%. And take a look. At 137, I lose a little less. I make a little less than I would have. But at higher, I do better and better. And then I eventually get tapped out. And we can look at it the day before earnings. So here's what this spread will look like on February 1st. And you can see if it goes to 137, I'll make money, even with vol dropping. And really, let's look at just the second. And then we'll call it a day. So when it opens the morning of the second, this is what my P&L will look like. I'm going to have a tough time losing. Even if volatility drops 60%, which it won't. So there's how I would set up my Facebook trade. All right, guys. Anybody have any? Hi, Mark. Can you give? Oh, yes. Trevor, just email me and I'll give you the Gamma webinar for free. What's a vol? That's if volatility is up or down 60%. All right, any other questions? So we all know, we all want to check out that Gamma thing. And if you hate the thing or if it's worthless, then I'll give you something that'll be worth it. Trust me, it's worth going to. Everybody that takes these Saturday classes loves them. No. So Trevor had paid for another course that we canceled. And he did not, and I offered a refund or access to the next course that we were doing. So he chose the next course. And Trevor will probably tell you that I think he's taken a bunch of our stuff, and they're pretty good. What's the code? It's 25_OFF, and that's all capitals. Capitals do matter. And I do have a special deal with Vol for Lightspeed, better than their published rate. You can email me on that as well. Mark@optionpit.com. And it's officially been an hour and 8 minutes. Obviously, I didn't start till 7:35, but I think we've done a good amount of time here today, folks, right? All right, guys, I'm looking forward to seeing you on board. It's at 8:30 a.m. Central. All right, folks. I hope everybody has a great evening. It was a pleasure talking to all of you, and I'll see you guys tomorrow, or I'll see you guys Saturday.